Asset allocation. Asset allocation is the cornerstone of private wealth management because it determines how a client's wealth is distributed across asset classes to achieve financial objectives while managing risk. Unlike institutional portfolios that often focus on benchmark relative performance, private client asset allocation is driven by individual goals, constraints, and life circumstances. Wealth managers must consider factors such as risk tolerance, return requirements, liquidity needs, tax considerations, time horizon, and family objectives. Effective asset allocation aligns investment decisions with a client's overall wealth plan rather than focusing solely on maximizing returns. The process requires balancing growth, income generation, capital preservation, and flexibility to ensure long-term financial success and sustainability. Private wealth managers commonly use strategic asset allocation as the foundation of portfolio construction. Strategic allocation establishes long-term target weights for asset classes such as equities, fixed income, cash, real estate, and alternative investments. These allocations reflect the client's objectives, financial circumstances, and ability to tolerate risk. Equities generally provide long-term growth potential but introduce higher volatility, while fixed income investments offer income and stability. Alternative assets may provide diversification benefits and inflation protection. Strategic asset allocation serves as the portfolio's long-term blueprint and helps maintain discipline during changing market conditions. Periodic rebalancing ensures that asset exposures remain consistent with a client's intended risk profile and investment objectives. Risk capacity and risk tolerance are fundamental considerations in determining an appropriate asset allocation. Risk tolerance reflects the client's psychological willingness to accept uncertainty and market fluctuations, whereas risk capacity measures the financial ability to absorb losses without jeopardizing important goals. A wealthy client may possess high risk capacity but low risk tolerance, requiring a more conservative portfolio despite substantial financial resources. Conversely, younger clients with long investment horizons may tolerate greater short-term volatility. Wealth managers must evaluate both dimensions carefully to create portfolios that clients can maintain through varying market environments. Successful asset allocation balances financial realities with behavioral considerations and emotional comfort. Human capital plays a significant role in asset allocation decisions within private wealth management. Human capital represents the present value of future earnings and can be viewed as an asset that influences overall wealth. Clients with stable employment and predictable income streams effectively hold a bond-like asset in their human capital, potentially allowing greater exposure to growth-oriented investments. Conversely, entrepreneurs or individuals with volatile earnings may already face substantial economic risk, supporting a more conservative financial portfolio. Wealth managers assess the interaction between human capital and financial capital when designing investment strategies. Integrating these factors leads to more comprehensive and personalized asset allocation recommendations throughout the client's lifecycle. Goals-based investing further influences asset allocation by linking investments directly to specific client objectives. Rather than viewing wealth as a single portfolio, advisors often allocate assets according to separate goals with varying priorities and time horizons. Essential goals such as retirement income, healthcare funding, and lifestyle maintenance typically receive conservative allocations emphasizing certainty and capital preservation. Aspirational goals, including legacy creation, philanthropy, or luxury spending, may support greater risk-taking. This framework improves client engagement because portfolio success is measured by progress toward meaningful objectives rather than market benchmarks. Asset allocation therefore becomes a practical tool for translating personal goals into actionable investment strategies. Tax management. Tax management is a vital aspect of private wealth planning because investment decisions should be evaluated based on after-tax outcomes rather than pre-tax performance alone. Taxes directly affect portfolio returns, wealth accumulation, and the achievement of financial goals. Wealth managers seek to enhance after-tax wealth by integrating tax considerations into investment selection, asset allocation, transaction timing, and wealth transfer strategies. Effective tax management requires a detailed understanding of applicable tax laws, account structures, and client circumstances. Since tax rules vary across jurisdictions and evolve over time, advisors must continually monitor changes and adjust strategies accordingly. The objective is to minimize unnecessary tax burdens while maintaining compliance and supporting long-term wealth objectives. Different asset classes generate returns that may receive different tax treatments, making tax-aware asset allocation particularly important. Interest income from bonds is often taxed at higher rates than long-term capital gains or qualified dividends. As a result, tax-efficient assets may be more suitable for taxable accounts, while tax-inefficient investments can be placed in tax-deferred or tax-exempt accounts. This practice, known as asset location, enhances overall portfolio efficiency without changing the desired risk-return profile. Wealth managers analyze expected returns, tax rates, investment horizons, and liquidity needs when determining optimal asset placement. Proper asset location can significantly improve long-term after-tax performance and increase wealth preservation opportunities. Tax management also involves controlling the timing and recognition of taxable events. Investors may defer capital gains by holding appreciated assets longer, thereby postponing tax liabilities and allowing greater compounding of wealth. Tax loss harvesting provides another valuable strategy by realizing losses that offset taxable gains and reduce current tax obligations. Wealth managers must ensure that such strategies remain consistent with investment objectives and comply with applicable regulations. In addition, charitable giving, gifting programs, trusts, and estate planning vehicles may provide opportunities to reduce taxes while supporting personal and family goals. Through disciplined implementation, tax management strategies contribute meaningfully to overall portfolio efficiency. Comprehensive tax management extends beyond investments to encompass retirement planning, wealth transfer, and multi-generational wealth preservation. High-net-worth families often face complex tax issues involving estate taxes, inheritance taxes, gift taxes, and cross-border holdings. Wealth managers collaborate with accountants, attorneys, and other specialists to develop coordinated solutions that optimize after-tax outcomes while respecting family objectives and legal requirements. Effective tax management supports asset allocation decisions, enhances liquidity planning, facilitates succession strategies, and preserves family wealth across generations. Ultimately, integrating tax considerations into every stage of the wealth management process helps clients retain more of their investment returns and improve the probability of achieving long-term financial goals.